Welcome back to another episode of How to Make Money with Hard Money, joined by my faithful partner here, Caleb Delgado, per usual.
Hello, everybody. How's everybody doing today? How you doing, Dave?
All right, I'm doing good, All
right.
So today we were going to talk about applications and underwriting.
Yep, the infamous application. And I think the best way to start with an application is the purpose, right? Why do people put their information on these pieces of paper for gentlemen like us to read?
Yeah, good question. Why don't you answer that for us, Caleb?
Well, I think the first part for everyone to understand is it's your resume, right? You're asking for a loan and you want to present yourself in the best way that you'll be approved right away with the least amount of questions and the least amount of resistance, right? So I think that's really the purpose of the application. And then I think...
Yeah, show the lender who you are.
Right. I mean, that's what we're trying to say is like, okay, this is who I am. This is how I can execute with limited resistance and be successful at the end of it on a timely schedule, right?
Yep. And so, I mean, there's probably some differences too. We know like when people say loan applications, if you've ever bought a home before, you probably filled out like a 1003 application.
Right.
So what's the difference, if there is one, between a DKC lending application, like a private hard money application, and a conventional bank lender?
There is a massive difference. And for most people who've bought a home before or even just filled out a 1003, they're basically asking for your firstborn child. They're going to go into all of your finances from, every penny that goes in and out of your bank statement to, how long you've been at your job, to the assets that you have in your 401ks, to experience that you've had in the past. So it's extremely detailed and it can be very rigorous in the time of it. But a DKC application going into that is about the asset because we're asset-backed lenders. So we really want to focus on your down payment and your ability to execute your plan. That's where we kind of focus on that asset value.
Sure.
So
yeah, and I know there's on a 1003, do they, they're asking for, as you said, some supplemental documents that are different as well, like personal financial statements or PFS, tax returns perhaps, and bank account statements, all of that as well. And you have to kind of cite that and gather all of that information in one spot. I mean, what else is on our DKC application? So certainly we're an asset-backed lender, so the asset information's there. But I know there's other items as well.
Yeah, so we're going to ask you a little bit about your experience, because in life, it's not just, hey, we want to give you money just because you have the down payment. It's, we want to know that you have real estate experience, you have the ability to execute a plan on, maybe rehabbing the property or even the ability to refinance the property on an exit. Because do you have the chance to buy the property at the right price? You have the ability to execute the plan of whatever you're trying to accomplish, whether it's turn it to an Airbnb, regular long-term rental, and or refinance and get out of your loan via sale or refinance. So that's the purpose of the DKC application, nothing more.
Yeah, I know you get some kickback sometimes on that question too about some of the personal information that you just mentioned because, DKC lending is an asset-backed lender.
Right.
So then I know on occasion we will ask for some personal information, right?
Yeah.
Why do we do that? And why would we maybe ask for?
So the personal, all of our loans are personal guaranteed. And it's important to understand what that is you're signing a documentation in representation of an LLC corporation or a Florida land trust. These were Florida-backed lenders. And then the purpose of that also is to have a personal guarantee where if something is to go wrong, you're personally liable to pay that debt back. So really, that personal information is to guarantee the legal side.
Yep, that's exactly right. So like a social security number, obviously you need to be able to identify the person to file against the personal guarantee.
Yeah, so in a foreclosure process, you can't file legal documents and not know who the person is and not have their social security number. Those are important numbers to have.
Yep.
But, for us, we're not here to foreclose on anybody, right?
Yeah, exactly. So then also, I know with that, there's, some additional documents that we may ask for on occasion. Like you mentioned, a credit score. We don't do a hard credit pull ever.
Right.
But on occasion, we've asked for a credit screenshot.
Yeah.
Or perhaps, and even some occasions, we've asked for a personal financial statement. Why would an asset-backed lender ask for those items?
So like I was saying before of some of the elements with the applications to understand how people will exit. Yeah. So that gives us a clear view if the person just has the ability to. Yeah. We don't ask for credit, but in order to get refinancing debt, first thing they're going to ask is what your credit score is. Yep. Other thing is they want to know your debt to income ratio. Well, a personal financial statement will show your debts and we'll understand if they fall within the ratio to qualify in the back end.
Sure.
Because if a borrower comes and says, oh yeah, I'm going to refinance, no problem, and then they have a 400 credit score, well, the chances of that is highly unlikely. So then we know they're not set up for success. And like we were saying before, we're not here to take back people's properties. Exactly. We're here to make sure that they buy the property right, execute their plan, and have success at the end. not take what's theirs or what they're trying to accomplish.
I love it. That's a perfect answer. I'd even add to it that, we're only doing that really when the LTV is tight as well, as like additional compensating factors. Because I promise you, if you come and apply for a hard money loan with DKC Lending at 20% loan to value, we will never ask you for a personal financial statement or credit screenshot.
No, we're not going to ask for anything, really.
Yeah.
But that brings us to a really good point, because you're talking about compensating factors. That brings us to underwriting, right? The application is to get you to underwriting, so then underwriting can, approve the deal. So for you, because I know you do a lot of our underwriting as well as using our, softwares and other resources to get through underwriting, what's the purpose of underwriting and what are you looking for?
Yeah, for us, I mean, if you were to ask me what's the number one key to underwriting approvals for DKC Lending, it's LTV.
Okay.
It's loan to value.
Right.
So for us, the lower the loan to value, the easier the approval. Our maximum loan to value right now is 70% of the as is value of the asset. So if you're at 70% LTV or your request is 70% LTV and maybe even 50% construction financing, those are the highest loan to value capacity that we have. So, we'll scrutinize that deal a little bit closer than if it was, like I said, a 20 or 50% loan to value, because there's more wiggle room.
Right. And so when you have a deal that is more maxed out on the qualifications that you're looking at for the underwriting, what compensating factors other than just the asset and the down payment would you look at so people can get the approval that they're looking for?
Yeah. So, there's no hard and fast rule. We look at every file differently and unique to the situation and location, how they're buying the asset, if they're buying it and what they maybe purchased it at or their cash basis. But essentially for us, compensating factors could look like experience. If you have completed 10 flips in the last 12 months and you're or 10 refinances, let's say, and you just completed 10 refinances to DSCR loans and you're applying for a DSCR refinance exit, then it makes it a lot easier of an approval and having confidence about the borrower. So, and then just liquidity, you and I always say, you're the king of saying this one, is that if they can buy the loan out at any point in time, then that really is a really strong compensating factor, meaning that if they, take $100,000 loan, and they show a bank account of $100,000 cash,
right?
They can get out of the jam if they have one. And somebody might ask, why would they borrow $100,000 if they have $100,000 cash? And leverage is the answer.
Right.
To that.
Right. Because they're multiplying with other deals and they need to, spread it a little bit across them.
Exactly.
To make their returns better. But I would say, we get a lot of questions of why does DKC max out at 70 loan to value when there's a lot of other companies that are offering 90%, 100% constructions.
Yeah.
But why would we do that?
Yeah, that's a good question, and that's actually an industry standard also, and it's been an industry standard for a long time. I know you say quite often how we've been 12% interest for the last 10 years and for the next 10 years.
Yeah,
it's similar to the 70% loan to value.
Okay.
I've learned that it's 70% primarily because default interest in Florida and our loan documents is 18% per annum, which is essentially 18% LTV.
Right.
18% of the loan amount.
Okay.
So if you're at 70%, let's use the $100,000 example. You have a $70,000 loan.
Okay.
Well, you're going to add $18,000 onto that balance if it takes you 1 year to foreclose. Then you may have to pay a tax bill, insurance, and attorney fees and filing fees on top of that to file the foreclosure and repossess the asset.
Okay.
And often that total, especially when it's under $1 million loan amount, is 25% of the loan total. That's very common.
Okay.
And then if you're going to dispose of the asset to get your capital back, you're going to list it. And the very common, transactional cost is about 5%.
Right.
So when you take into consideration a 5% disposition and a 25% repossession, there's your 70% LTV from an industry standard perspective.
So from a lender's perspective, you technically lose on that loan at 70 loan value.
You're breaking even at there. And that's if everything goes perfectly. And you can get through a 1 year foreclosure. If there's second and third mortgages or code violations or construction, it could cause more issues at the auction. And you could, absolutely, you could end up losing money. And we've seen several lenders lose money at 70% LTV. By the way, that's not even accounting for any market correction. So, we've seen prices drop 10% in the state of Florida over the, depending on the market over the last 18 months. So if you have a 10% price decrease and then you have a foreclosure that extends out, there's the high likelihood that you'll have a deficiency.
Wow. So really it's important for investors to understand what a deficiency looks like, really, to get approved.
Yeah.
So if you're going into underwriting and you don't understand what that is, it can affect your deal. Because I know a lot of people call me all the time and just say, okay, give me the 90%. You know, they're giving me 90%. And I'm like, and I have to explain.
Yeah, what's the difference, right? Why can some lenders do 90%?
Yeah.
How do you answer that?
Yeah, no, for sure. Well, you have larger groups, you know, billion-dollar corporations or billion-dollar hedge funds that give out money and they could spread across their risk on that many loans. They can take losses.
Right. They're doing hedge funds, risk. Yeah.
Risk mitigation.
Exactly.
So as us, we look at each loan as its individual loan, right? We give people that kind of personal attention. You know, we're not some big billion-dollar company.
And we're not selling the notes on a secondary market. You know, we hold our notes on the balance sheet. We service them ourselves. So, you know, these notes are our fiduciary responsibility to our investors as well. So, so absolutely. Yeah.
And that's when I tell people, and I go into the conversation of that you lose the intimacy when you go to companies like that. Because one thing we know about real estate, it can be very unpredictable at times.
Yeah.
You know, everyone likes to forecast and say, this is what's going to happen. Everyone's talking about the rates dropping, all these things, but no one knows.
Well, the biggest factor too there on the 90% LTV is really that those lenders are qualifying the borrower and the asset.
Yeah.
You know, as we mentioned, we're asset-backed lenders. So
Correct.
we're not doing a hard credit pull, getting an appraisal, you know, which would take 21 days to close. We can close in 3 to 5 business days or faster at times if you have clear title and it's the right LTV. So, I mean, it's like comparing apples to oranges. They're different lending criterias. They're, you know, doing asset and borrower. We're doing asset. So, you know, it's a completely different game.
Yeah, and going back to that is like the relationship matters, right? People are asking for adjustments all the time. But when you have an intimate relationship with your lender who you're not just a number or a credit score or one of those factors, we can actually pivot with borrowers to make their loans more successful in case of the oopsies or the things that happen during real estate.
Yeah, that's a great point. And so, you know, I think important to go back to some of the compensating factors as well, and some ways that we've been trying to navigate those, especially in a tough market. And when we have seen value issues or differences in opinion on value, let's say, or even condition. And, you know, let's talk about some of the tactics and tools we're using as a lender to try to still make deals happen. Yeah.
I mean, well, one of the biggest things when we are focusing on deals is why we'll ask for real estate schedules.
Yeah.
You know, we ask borrowers for real estate schedules because sometimes, you know, the loan to value isn't there, or, you know, maybe the location is questionable and it's gentrifying at that time and they might be early to the market there. So if we can see a real estate schedule, we might be able to leverage other assets to give them more capital, you know, at a way that we feel comfortable, because that's what matters is both the borrower and the lender is comfortable in the transaction. And then we can give them the leverage that they need. But if we don't have that real estate schedule and a compensating factor, what adjustment do we know? We just see that one particular asset, that one particular transaction, and the deal begins and dies right there. But with the real estate schedule, we can pivot. So that's a huge one.
Yeah. I mean, we've even, as you know, obviously the main asset is a first position mortgage, but we've added second mortgages, you know, behind secondary collaterals as well, just to get that extra cushion on the LTV. Also the holdbacks, right? Construction holdbacks is a huge tool for us. You know, not all lenders offer construction holdbacks and administer draw schedules. So the fact that we're doing holdbacks, you know, there's a couple times this week where borrowers made requests that we didn't feel comfortable making at the time of closing. But, you know, once they had planned to do a lot of capital improvements. So once the improvements were done, you know, we felt comfortable at the final loan amount. So to get them there without having to do a loan mod or have them do 2 closings, the construction holdback is a really effective tool.
Yeah, and that goes back to a legal part that we did, and we customized our loan documents to be modifiable. Not every lender has that ability. You know, for us, modifying a loan is not something we always want to make the right decision at the day of closing. But we can't be predicting everything. So when we have to modify a loan, DKC loan docs are modifiable to make those adjustments to help the borrower.
Right. Yeah. I mean, primarily done in new construction settings. We've seen most of our loan modifications have been in new construction deals, I would say. So, you know, cost overruns or even people doing them intentionally. I mean, you know, you need to do one loan to acquire the land and you need another loan to do construction. And so instead of maybe closing a hard money loan for the acquisition and then closing another construction to perm loan or something like that, if we can modify the loan, you have one closing, it can save the borrowers a lot of money. You get to deal with one lender instead of 2. So there's a lot of positives to that. And we've even seen, just to add to that, it's like a triple lot or a double lot, and you want to build the first house,
right?
Sell it, or maybe as it's 70-80% through, they want to start construction on the second lot, so we can modify the loan to begin construction on a second structure.
And just as easy as even removing the collateral, because you're selling the, you have a finished product, you have to sell it.
Yep.
You get a sale price. Yeah. Some lenders say, no, that's collateralized on the other loan. Well, we can maneuver assets in and out of the loan to really compensate for that.
Yeah. Yeah. Good points.
So I think that's a big thing. And I didn't know if you wanted to go into some of the ways we help borrowers with SiteWire and things like that. I think that's pretty big.
Yeah, sure. I mean, we talked about it, I think, on our last podcast about partnering with a third party company who's helping us administer draws more efficiently. We've had that internal and as a servicing function, and so it still does come through our servicing department, of course.
Absolutely.
But we partner with a third party company who has a general contractor that's assigned to the deal and can help process, answer questions. They have a really cool software that kind of geotags the location so the borrower can take photos and videos to submit themselves.
Yeah.
They don't need to schedule an inspection and, have all of the lockbox combinations and getting into the property issues as well. So it's been a huge, huge help for us, and our borrowers seem to have adapted well to the transition so far, and we only see that getting better.
Yep, for sure. And I would ask the question, so if someone's in underwriting, what would be the easiest way to be approved with the least complication?
Loan to value. Submit a low loan to value loan.
Yeah. So it always goes back to loan to value.
Yeah, I think it's always loan to value for us. We're asset-backed lenders, So if the loan to value is right, the approvals are easy. When the loan to values are tighter, we need more additional information or, to compensating factors to get the loan approved.
Yeah, because I know I get the comments from borrowers all the time. Hey, it's me. You know what's going on, and they just say, "Trust me." How many times a day do we get the "Trust me, it'll work"? It doesn't work that way.
Unfortunately, we love to trust people, but we're not in the business of just trusting. Because life happens to people too, and it's not always people's fault when there are issues that arise, and
of course,
there can be accidents, deaths, life events.
We've had several of them.
Yeah, so.
People say, "Oh, nothing will happen." I mean, unfortunately we've had several clients die, and we've had to deal with children and widows and really navigate and help. But these things, like I said, life happens.
Yep.
And that's why it's even more important to have a lender where you have a relationship with.
That is true. I was going to say, you got to end us on a positive note now after that.
Yeah, after that, not talking about death. But on the positive note is, if you want the fastest approval, loan to value and your down payment matters, or collateralizing other pieces of real estate. And having an intimate, relationship with your lender is the key.
Yeah, we're a lender. We try to be a lender that's flexible, understanding of situations, even like permits, code violations. It's all about the plan of attack on these issues. And if something does need to close because of, an immovable object per se, then, we want to do it with the right strategy and, exit plan in mind, as protecting ourselves, but also with the best interest of our borrower.
Right. So don't be afraid to give us all of your questions. And at the same time, make sure you have your down payments.
Yeah. And we're taking questions for the next podcast, right? So we're going to put out a link that you can submit your question, and we'll see if we can answer it on the next one.
Yeah. All right. Well, thank you for your time, everybody.
Thanks, everybody. Thanks for joining us for another episode of How to Make Money with Hard Money. Like, subscribe, and follow on all social media platforms, and you can catch us on Apple Podcasts and YouTube.